So he said, is there a minimum amount of cash flow needed for you to personally think about buying a deal? So yes. Let me present to you the calculator again. I'll explain that to you by showing you. So for this one, right, it says on the calculator, it says net cash flow monthly and cash on cash return. So this ties into the capital question. Like, my cash on cash return, because I'm raising money from other people, needs to be enough that I am paying them solid returns. They're getting a good investment opportunity. It makes sense for them. And there's something left over for me to be in this deal. I personally, like, long-term rentals only generate you so much money. This is a fake example, but in this example, this $240,000 property is renting for $2,450, and I was disregarding all the expenses and all that stuff. We're not going to get into it, but it generates $388 a month, and it costs you $49,000 to get into this deal, which generates you a 9.5% cash on cash return. I'm looking for cash flow in this instance to be over 100, cash on cash return to be over 10%. It's very hard on a long-term rental to get much more than a few $100s a month in cash flow, where in reality, I'm looking for, ideally on a pad split, I'm looking for over $1,000, because then when I split that between a partner and I, we're each making several $100s, right? This is $1,273 and $1,000, making $700, and we're getting solid return on our money. So is there a minimum? You're really basing it on cash flow and your cash on cash return. If you don't have a high enough cash on cash return, if this thing was generating you $2,434, but your entry cost was right $320,000 to generate $2,400 of cash flow, let's go even higher. In this instance, there's so much cash flow that it is still a solid cash on cash return. I'm looking at both, right? There needs to be enough cash flow. No, there needs to be a high enough cash on cash return that I can split that with a partner and we're both getting the returns that we're looking for. And that's like why this calculator makes it a breeze. It tells you if you have a partner and you're splitting, let's say in this instance, 30% ownership, 30% cash flow, and you give them 5% for return, this is all their returns right here. These are your returns, right? You have infinite because you're putting no money in, just your time, your sweat equity. But this is the breakup of what that looks like. And then in the future, when you sell it, right, 1 year, 5 year, 10 year, 20 year snapshots, I need to make sure that my deals are generating enough cash on cash return to split with a partner that we're both getting what is reasonable for both of us. And then it's cash flow. Well, we can get on the opposite end of the spectrum, and let's increase this cash on cash return, or let's decrease this to make it. See, it's just so small. So you could, let's say you're close to this 10%, right? And maybe you say, okay, based on cash return, I want to buy it because it's a very low entry. Well, that means we're going to be splitting $40 of cash flow. Is it worth my time and effort? Even though the cash on cash return may be high enough, is it worth it for $40 of cash flow to split with someone else? No, it doesn't make sense for me. And any one little variable can wipe away $40. So I like to have a few $100s. So when there's volatility, that we're still cash flow positive, even though there's some volatility throughout the months. And that there's a dollar amount that's like, okay, a few $100 splitting, it's worth all this time and effort to split a couple $100. But if it's $40 and we're each making $20 or $50 or $100, is all this risk and time and effort worth it to split $50, even if the cash on cash return is there? It's a dance between the two, by understanding that you need a high enough cash on cash return to ensure that you have the returns you're looking for and your partner has the returns they're looking for from a percentage of what you're investing. For you, it's infinite if you're raising all the money, and for your partner, they need to justify that the money they're putting in, they're getting solid returns from that, or that you have enough cash on cash return, right? Enough cash flow to pay a private money lender if you're just borrowing it from a lender. But then after, if it hits that criteria, is it enough dollar amount that when you do split it, it makes sense for you? If I'm providing them 30% ownership cash flow and 5% for return, that means at the end of the year, is this $40 worth it? You decide that. I don't think it's worth it. I think it's too risky. It's not worth it. But it's like the balance between cash on cash return and cash flow. It's kind of my main takeaway there.